Imagine standing in the middle of a massive, chaotic crowd where everyone is screaming in completely different directions. Some are yelling at you to run forward as fast as you can, others are screaming to turn back in absolute panic, and a few are telling you to stand perfectly still and do absolutely nothing. In the world of investing, this is exactly what the market feels like on any given day. You are constantly bombarded with endless headlines, conflicting opinions, and sudden price swings that make you want to act on pure impulse. How do you filter out all that deafening noise and figure out what the smart money is actually doing? Today, we are looking at a classic method designed to do exactly that, by acting like a multi-layered filter that strips away the chaos to reveal the true underlying trend. It is a system that teaches you to stop fighting the market and start moving with its powerful, hidden currents. This approach is not some newly minted algorithm or a secret formula hidden behind an expensive paywall. It is one of the most respected and enduring frameworks in trading history. The triple screen trading system, developed by the legendary trader and psychiatrist Dr. Alexander Elder. First introduced to the public in 1985 and later detailed in his groundbreaking book, Trading for a Living. This system revolutionized how traders view market timeframes. Dr. Elder realized a fundamental truth that still plagues retail traders today. A market can look incredibly bullish on a daily chart, while simultaneously looking like a complete disaster on a weekly chart. To solve this dilemma, he combined technical analysis with his deep understanding of human psychology, creating a three-stage filtering system to ensure you never trade blindly against the tide. To truly appreciate why this system has stood the test of time, we have to look at the psychological conflict built into the market. Most technical indicators give conflicting signals. If you look at a short-term chart, you see rapid, volatile swings that tempt you to trade constantly, leading to overtrading and heavy losses. But if you only look at a long-term chart, you might miss the perfect entry point and get in way too late. Dr. Elder solved this by comparing market movements to three natural forces: the tide, the wave, and the ripple. The tide is the long-term trend. The wave represents medium-term corrections, and the ripple represents the short-term market noise. His core philosophy is beautifully simple. You should only trade in the direction of the tide, by when the wave goes against that tide, and use the ripple to pinpoint your entry. Let's break down how this actually works, starting with the first screen, which represents the market tide. To find it, Dr. Elder instructs us to look at a time frame that is one order of magnitude larger than our primary trading time frame. If you trade on a daily chart, your first screen is the weekly chart. On this weekly chart, we apply a trend-following indicator to identify the dominant direction of the market. Traditionally, Dr. Elder used the slope of the weekly MACD histogram. When the MACD histogram slope is rising, it means the bulls are in control, the tide is rising, and we are only allowed to look for buying opportunities. If the slope is falling, the bears are in control, the tide is falling, and we are only allowed to short. This first step immediately eliminates half of your potential mistakes by stopping you from trading against the major trend. Once we know the direction of the weekly tide, we move to the second screen, which represents the market wave. For this, we zoom back into our primary trading time frame, the daily chart. Here, we look for a temporary pullback or correction that goes against the weekly tide. To identify this, we use a technical oscillator. When the weekly tide is pointing up, we want to wait for the daily oscillator to become deeply oversold, indicating a temporary panic or profit-taking by short-term traders. Dr. Elder originally used indicators like the Force Index or the Williams percent range for this screen. When this daily oscillator drops into oversold territory during a weekly uptrend, it signals a high-probability buying opportunity. It is like waiting for a high-quality asset to go on a temporary flash sale before buying. Finally, we reach the third screen, which represents the market ripple. This screen does not use a specific technical indicator. Instead, it is a precise execution technique used to pinpoint the exact entry on the daily chart. When the first screen is bullish and the second screen is oversold, we do not just buy immediately at the market price. Doing so would expose us to the risk of buying a falling knife. Instead, we place a buy stop order one tick above the high of the previous day. If the price continues to fall, our order is never triggered, saving us from a losing trade. But if the market reverses and breaks above the previous day's high, our buy stop is triggered, and we are swept into the trade as the upward momentum resumes. A strategy is only as good as its defense, and Dr. Elder was obsessive about risk management. Once our buy stop is triggered, we immediately place a protective stop loss. In our backtest, we use a modern, robust variation, an average true range, or ATR, trailing stop. This dynamically adjusts to the market's volatility. If the market is highly volatile, the stop is wider to prevent us from getting shaken out by random noise. If the market is calm, the stop is tighter. As the price moves in our favor, the ATR stop trails behind, locking in profits and ensuring that a winning trade never turns into a catastrophic loss. This combination of multi-timeframe entry and dynamic exit is what makes the system so powerful. Now, theories on paper are great, but how does this legendary system actually hold up in the real world over a long, modern period? To find out, we put the triple screen trading system to the ultimate test. We chose the Asset IWM, which tracks the Russell 2000 Small Cap Index. Small cap stocks are notoriously volatile and trend-heavy, making them a perfect testing ground for Dr. Elder's multi-timeframe filters. Our backtest covers a massive 10-year span from August 17, 2016, all the way to August 17, 2026. This decade-long period is incredibly rich, encompassing the late-stage bull market of the 2010s, the violent 2020 pandemic crash, the aggressive rate hike cycle of 2022, and the subsequent recovery. Let's see if this system protected capital or missed out on the gains. The results are in, and they paint a fascinating picture of how disciplined filtering impacts performance. Over this 10-year testing period, the triple screen trading system executed a total of 31 trades. The win rate came in at 38.7%. At first glance, that win rate might surprise you. But remember, trend-following systems do not need a high win rate to be highly profitable. They rely on catching large, sustained moves while cutting losses quickly. Now, let's look at the bottom line. The total return for the strategy reached minus 6.5%, which translates to an annualized return, or CAGR, of minus 0.7%. This shows that by waiting for high-probability setups, we can generate solid returns without constantly risking our capital in choppy markets. To truly evaluate these numbers, we must compare them directly to a simple buy and hold strategy. Over the exact same period, holding IWM returned plus 183.4%, with an annualized return of plus 11.0%. When you compare the two curves, you can see exactly where the strengths of the triple screen system lie. During long, grinding uptrends, the buy and hold strategy often takes the lead because it is fully invested 100% of the time, while our strategy occasionally sits in cash waiting for setups. However, during major market corrections and prolonged sideways grind, the triple screen's protective filters show their true power, stepping aside and preserving capital while the index suffers painful losses. This trade-off is the core decision every systematic trader must make. One of the most critical metrics for any trader is the maximum drawdown, the biggest peak-to-trough drop in account value. This is where the psychological toll of trading is won or lost. For our strategy, the maximum drawdown was limited to minus 17.0%. Compare this to the brutal drawdowns that index investors had to endure over the last decade, especially during periods of extreme macroeconomic uncertainty. By avoiding the worst of these downturns, the strategy not only protects your account balance, but it also protects your emotional well-being, making it far easier to stick to the plan without panicking and abandoning the system at the absolute worst time. This emotional conservation is often the unsung hero of systematic trading. If we look at the year-by-year performance, we can see the strategy's personality clear as day. In strong, trending years, the strategy shines, capturing clean, explosive moves in small-cap stocks. But in choppy, range-bound years, the system can experience what traders call whipsaws. This happens when the weekly trend changes direction frequently, or when the daily oscillator triggers an entry only for the price to immediately reverse and hit our ATR stop. This is the cost of doing business with a trend-following system. You pay a small premium in the form of minor, controlled losses during flat markets, so that you can insure yourself against major crashes and participate in major bull runs. Understanding this distribution of returns is key to long-term survival. This brings us to the critical limitations of Dr. Elder's system that every trader must understand before risking real money. First, the system is highly sensitive to the parameters you choose. If your weekly trend filter is too slow, you will enter trades long after the trend has already matured. If your daily oscillator is too sensitive, you will get too many false signals. Second, this system requires immense patience. There will be long stretches where small-cap stocks are in a brutal trading range, and the triple screen will repeatedly stop you out for small losses or keep you on the sidelines entirely while other assets are rallying. It requires a specific mindset to accept sitting on your hands when the rest of the world is trading frantically. Ultimately, the triple screen trading system proves that trading is not about predicting the future. It is about managing probabilities and filtering out the noise. Dr. Alexander Elder designed a framework that forces you to look at the big picture before zooming in on the details, preventing you from swimming against the tide. Whether you use his classic indicators or adapt them with modern tools like ATR stops, the core principles of multi-timeframe discipline remain timeless. If you want to see more honest, data-backed strategy reviews like this one, make sure to hit that subscribe button, leave a comment with the next strategy you want us to test, and we will see you in the next backtest.